The skyline of every major American city tells a story that most people never read. Those gleaming towers of glass and steel, monuments to corporate power and economic ambition, are today facing a reckoning that could reshape the entire financial landscape. In the next 18 months, $957 billion in commercial real estate loans will come due. That number is not an abstraction. It represents thousands of office buildings, shopping centers, and business complexes whose owners must either refinance their debt or face the consequences. But here is where the story becomes truly unsettling. Many of these properties are now worth far less than the loans they secure. In cities like San Francisco and Austin, office vacancy rates have surged past 25%, levels not seen since the depths of previous economic crises. Workers who once filled these buildings 5 days a week now come in sporadically, if at all. The pandemic accelerated a transformation that was already underway. And now the financial system must confront a fundamental question. What happens when the collateral backing nearly $1 trillion in debt has lost its value? This moment has a strange familiarity for anyone who studies economic history. The specific circumstances are unique, but the underlying dynamic has played out before, most dramatically on the other side of the Pacific Ocean more than 3 decades ago. To understand where American commercial real estate may be headed, we must travel back to Tokyo in the late 1980s, when Japan seemed poised to dominate the global economy forever. The Japanese asset price bubble of that era created distortions so extreme they defied rational explanation. At the peak of the frenzy, the land beneath the Imperial Palace in central Tokyo was theoretically worth more than all the real estate in California combined. Office buildings in prime districts changed hands at prices that assumed rents would rise indefinitely into the future. Corporations and banks, flush with cheap credit, bid up property values to stratospheric heights, confident that Japan's economic miracle would continue without interruption. The mechanism driving this bubble was deceptively simple. Japanese banks, operating under regulations that allowed them to count unrealized gains on stock holdings as part of their capital base, had enormous lending capacity. They poured money into real estate, both directly and through loans to corporations and speculators. As property values rose, banks could lend even more, creating a self-reinforcing cycle. Developers built new office towers to meet projected demand that existed primarily in spreadsheets and feasibility studies. The rental income these buildings would supposedly generate justified ever higher valuations, which in turn justified larger loans. Everyone involved understood at some level that the numbers had detached from economic reality. But as long as prices kept rising, the game could continue. The Ministry of Finance, concerned about inflation and asset bubbles, finally began tightening monetary policy in 1989, raising interest rates and restricting credit to real estate. The bubble burst almost immediately. What followed was not a sudden crash, but a long, grinding deflation that came to be known as Japan's lost decade, though in reality it lasted far longer. Property values fell by more than 60% from their peak. Buildings that had been financed, assuming ever-increasing rents, now sat partially empty, generating income far below what lenders had projected. Borrowers could not refinance their loans at the original amounts because the underlying collateral was no longer sufficient. Banks faced a terrible choice. They could foreclose on borrowers and recognize massive losses, depleting their capital and potentially forcing them into insolvency. Or they could extend and pretend, rolling over bad loans and hoping that property values would somehow recover. Many chose the latter option. Japanese banks became riddled with non-performing loans, unable to write off losses, but also unable to lend productively to support economic growth. Developers and corporations that should have gone bankrupt remained technically solvent, consuming resources without generating real economic value. These so-called zombie companies became a defining feature of Japan's stagnant economy throughout the 1990s and beyond. The comparison to today's American commercial real estate market is not perfect, but the parallels are striking enough to warrant serious attention. Consider the office buildings constructed in major cities during the boom years of the 2010s. These properties were financed based on projections that assumed occupancy rates would remain high and rents would continue to climb. developers and investors looked at a world where corporate tenants competed for prime office space and extrapolated those conditions into the indefinite future. Banks underwrote loans using appraisals that reflected these optimistic assumptions. The financial engineering was sophisticated, involving complex debt structures and multiple layers of financing, but the fundamental premise was straightforward. These buildings would generate sufficient income to service their debt. Then the nature of work began to change. Even before the pandemic, technology companies and other employers were experimenting with flexible work arrangements. The sudden shift to remote work in 2020 accelerated this transformation beyond what anyone had anticipated. When workers finally returned to offices, they did not return in the same numbers or with the same patterns. Hybrid schedules became the norm, meaning that companies needed less physical space for the same number of employees. The implications for commercial real estate were immediate and severe. Tenants whose leases were expiring negotiated for smaller footprints or chose not to renew at all. Buildings that had been fully leased began showing vacancy. In some markets, the shift was dramatic. San Francisco, once a symbol of tech-driven prosperity with virtually no available office space, saw vacancy rates climb above 25%. Austin, which had been one of the fastest-growing commercial real estate markets in the country, experienced a similar reversal. These were not marginal properties in declining neighborhoods. Many of the empty or partially empty buildings were relatively new, well located, and equipped with modern amenities. The problem was not the quality of the buildings themselves, but rather a fundamental mismatch between the supply of office space and the actual demand from tenants. Property owners found themselves in an impossible position. The rental income their buildings generated was often insufficient to cover debt service payments that had been calculated based on higher occupancy and rental rates. Many hoped this was a temporary situation, that workers would eventually return to offices full-time and demand would recover. But as months turned into years, it became clear that a structural shift had occurred. Now the maturity wall looms. This term refers to the concentrated period during which a large volume of loans come due and must be either repaid or refinanced. In normal market conditions, refinancing commercial real estate debt is a routine transaction. The property has maintained its value or appreciated, rental income covers debt service with room to spare, and lenders are happy to extend new loans on favorable terms. But current conditions are anything but normal. Property values have declined significantly in many markets, sometimes by 30 or 40% from their peak. At the same time, interest rates have risen dramatically from the near-zero levels that prevailed during much of the 2010s. A property owner who took out a loan at 3% interest in 2017 now faces a market where comparable loans carry rates of 7% or higher. This creates a double bind. The property is worth less, meaning the owner may not be able to borrow as much as they owe on the existing loan. And even if they could borrow the same amount, the higher interest rate means much larger monthly payments that the property's rental income cannot support. Banks are responding to this situation with increasing wariness. Lenders who might have routinely refinanced these loans in the past are now conducting much more rigorous analysis of the underlying properties. They are asking hard questions about realistic rental rates and achievable occupancy levels. In many cases, they are concluding that the numbers simply do not work. The property cannot generate enough income to justify a new loan at current valuations and interest rates. This is where the possibility of widespread defaults enters the picture. When a borrower cannot refinance a maturing loan and does not have the cash to pay it off, default becomes inevitable. The lender must then decide what to do with the property. Foreclosure is the traditional remedy, but it is a costly and time-consuming process that forces the lender to recognize losses immediately. If the property is worth significantly less than the outstanding loan, the lender takes a direct hit to its capital. For large, diversified banks with substantial capital buffers, absorbing these losses is painful but manageable. For smaller regional banks with concentrated exposures to commercial real estate, the situation is far more precarious. This brings us to a crucial point about the structure of commercial real estate lending in the United States. While the largest banks hold significant portfolios of commercial real estate loans, regional and community banks are disproportionately exposed to this sector. For many of these smaller institutions, commercial real estate loans represent a substantial portion of their total lending activity. They know the local markets intimately and have long-standing relationships with developers and property owners in their regions. During the boom years, this specialization was a source of competitive advantage. These banks could underwrite loans that larger institutions might pass on, earning attractive returns in the process. But that concentrated exposure now represents an existential threat. A wave of defaults in commercial real estate could wipe out the capital of multiple regional banks simultaneously, creating exactly the kind of systemic stress that regulators fear most. History offers a cautionary tale about what happens when a large segment of the banking system faces losses from a collapsing real estate market. The savings and loan crisis of the 1980s and early 1990s provides a sobering precedent. Savings and loan associations, known as S&Ls or thrifts, were specialized institutions that primarily took in deposits and made loans for home mortgages and commercial real estate. During the 1970s and early 1980s, they faced a severe mismatch between the low fixed rates they earned on old mortgages and the high rates they had to pay to attract deposits in an inflationary environment. Regulators responded by loosening restrictions and allowing S&Ls to make riskier loans, including more commercial real estate lending. Many institutions took advantage of this newfound freedom to pursue aggressive growth strategies. They financed shopping malls, office buildings, and residential developments, often in markets where supply was already outstripping demand. When the real estate bubble of the mid-1980s burst, particularly in regions like Texas and the Southwest, S&Ls were left holding billions of dollars in non-performing loans. Property values had collapsed, and borrowers could not repay their debts. Institution after institution failed. The government's response to the S&L crisis ultimately cost American taxpayers more than $130 billion. The Resolution Trust Corporation was created to take over failed institutions, sell off their assets, and wind down their operations in an orderly manner. The process took years and left lasting scars on affected communities. Towns that had boomed during the construction frenzy saw completed developments sit empty for years. Banks that had been pillars of their local economies disappeared. The crisis also revealed significant regulatory failures and fraud, as some S&L executives had used their institutions as personal piggy banks, making loans to cronies and insiders with no realistic prospect of repayment. The parallels to today's situation are not exact. Regional banks in 2025 are not savings and loans from the 1980s. The regulatory framework has changed substantially, with stricter capital requirements and more sophisticated supervision. But the fundamental dynamic of a concentrated exposure to a declining asset class remains the same. The question of what happens next hinges on several interconnected factors. First, how much will property values ultimately decline? Second, how many borrowers will be unable to refinance or repay their maturing loans? Third, how will banks respond when faced with these defaults? And fourth, how will regulators and policymakers react if the stress on regional banks threatens broader financial stability? Each of these questions involves considerable uncertainty, but we can sketch out the likely contours of what may unfold. Property values in commercial real estate, particularly office properties, are likely to remain under pressure for an extended period. The shift to remote and hybrid work appears to be permanent, at least to a significant degree. Surveys of both employers and employees consistently show that flexibility in work location is now considered a standard expectation rather than a special perk. This means that demand for office space will remain below pre-pandemic levels for the foreseeable future. Some properties will adapt by converting to other uses, such as residential apartments or mixed-use developments, but this process is expensive and time-consuming. Many buildings are simply not suitable for conversion due to their design and location. The result will be a prolonged period of elevated vacancy rates and downward pressure on rents, which will in turn continue to depress property values. Given these conditions, a substantial number of borrowers will find themselves unable to refinance their maturing loans on acceptable terms. Some will attempt to negotiate extensions with their current lenders, offering to inject additional equity or accept modified terms in exchange for more time. Others will have no choice but to hand the keys back to the lender and walk away. The volume of defaults will depend partly on how flexible lenders are willing to be and partly on how much owners are willing or able to invest to keep properties afloat. But with $957 billion in loans maturing over the next 18 months, even a modest default rate would translate into tens of billions of dollars in losses. Banks will face difficult decisions about how to handle these troubled loans. The extend and pretend strategy that Japanese banks employed in the 1990s is tempting because it allows institutions to avoid recognizing losses immediately. A bank can restructure a loan, perhaps reducing the interest rate or extending the maturity, and classify it as performing even if the underlying property continues to struggle. This approach preserves capital in the short term, but creates zombie assets that drag on the institution's profitability and lending capacity for years. Alternatively, banks can bite the bullet and foreclose, taking immediate losses, but clearing bad assets from their books. This is the economically sound approach in the long run, but it requires having sufficient capital to absorb the losses without falling below regulatory minimums. Smaller regional banks with concentrated exposures may find themselves with no good options. If they foreclose on multiple large commercial real estate loans, the losses could exceed their capital cushions, rendering them insolvent. If they extend and pretend, they may limp along but be unable to support economic growth in their communities through new lending. Some institutions will likely fail, requiring intervention by the Federal Deposit Insurance Corporation. The FDIC will have to find healthy banks willing to acquire failed institutions or, if that proves impossible, liquidate the banks and pay off insured depositors. The prospect of multiple bank failures, even if each individual failure is relatively small, could create broader anxiety about the stability of the financial system. Regulators will be watching for signs of contagion, where problems at one institution spill over to others through interconnected funding markets or loss of confidence. The Federal Reserve and other authorities have tools to provide liquidity and support to banks facing temporary stress. But these tools cannot solve fundamental solvency problems caused by large loan losses. There is also a geographic dimension to this crisis that should not be overlooked. The impact of commercial real estate distress will not be evenly distributed across the country. Cities and regions that were particularly dependent on office-centric employment and that experienced the most dramatic shifts to remote work will face the most severe challenges. San Francisco, New York, Washington, D.C., and other major metropolitan areas with large concentrations of professional services firms are especially vulnerable. But the stress extends beyond these obvious cases. Smaller cities that invested heavily in downtown revitalization projects built around new office towers and retail developments may find that their bets have not paid off. The ripple effects will be felt in reduced property tax revenues, which cities depend on to fund essential services. Municipal governments will have to cut budgets or raise taxes on other property owners to make up for the shortfall, creating additional economic drag. Commercial tenants who remain in struggling buildings may find that landlords cut back on maintenance and services, leading to declining quality even for occupied space. The overall effect will be a gradual degradation of commercial real estate markets in the most affected areas. What makes this situation particularly challenging is that there is no obvious policy lever that can quickly restore value to commercial real estate. The Federal Reserve could cut interest rates, which would make refinancing easier and potentially support property values. But the Fed sets interest rates based on broader economic conditions, particularly inflation and employment, not on the needs of one particular sector. If inflation remains a concern, the Fed will be reluctant to lower rates simply to bail out commercial real estate investors and lenders. Fiscal policy could potentially play a role, perhaps through tax incentives for property conversions or infrastructure investments that make affected areas more attractive. But the sums involved are enormous, and direct government support for commercial real estate investors would be politically difficult to justify when many other sectors and groups also face economic challenges. The most likely outcome is a prolonged workout period. similar in some respects to what Japan experienced, though hopefully shorter and less damaging. The deeper lesson from this unfolding crisis is about the nature of asset bubbles and the difficulty of predicting when and how they will unwind. Commercial real estate in the 2010s was not characterized by the kind of obvious speculation and fraud that marked some previous bubbles. There were no mortgage brokers making liar loans to unqualified buyers, no massive securitization machines packaging up subprime debt and selling it as investment-grade securities. Instead, the bubble inflated through a more subtle process. A long period of low interest rates made borrowing cheap and pushed investors to seek higher returns in riskier assets. Commercial real estate fit the bill, offering attractive yields relative to bonds and other fixed-income investments. Banks, developers, and investors all made decisions that seemed reasonable at the time based on prevailing economic conditions and forecasts. But those forecasts failed to anticipate a fundamental shift in how and where people work. The pandemic served as a catalyst, accelerating changes that might have taken a decade or more to unfold under normal circumstances. Once the shift occurred, the disconnect between property valuations and economic reality became impossible to ignore. The question of whether this constitutes a true crisis or merely a significant adjustment depends largely on how the losses are distributed and managed. If defaults occur gradually over several years, with stronger banks absorbing weaker ones and capital markets providing funding to bridge temporary gaps, the system can likely muddle through without a systemic breakdown. This would still mean significant pain for investors, lenders, and communities, but it would not trigger a broader financial panic. The risk of a more severe crisis emerges if several factors combine in unfortunate ways. A spike in unemployment could reduce demand for office space even further and make it harder for borrowers to service debt. A sharp downturn in other asset markets could stress bank balance sheets from multiple directions simultaneously. Or a loss of confidence in regional banks could trigger deposit runs, forcing institutions to liquidate assets at fire sale prices and creating a downward spiral. Financial crises are often characterized by these kinds of cascading failures, where problems in one area metastasize and spread through interconnected channels. Looking forward, the commercial real estate maturity wall represents a test of the resilience and adaptability of the American financial system. The outcomes will depend on decisions made by thousands of individual actors, from bank credit officers evaluating whether to extend a troubled loan to corporate executives deciding how much office space their companies truly need. No single entity controls the trajectory of this unfolding situation, but history suggests that periods of significant asset price adjustment, while painful, also create opportunities. Properties that change hands at distressed prices become available to new owners who can reimagine their use. Capital that was locked up in unproductive assets gets reallocated to more promising ventures. Cities and companies adapt their physical infrastructure to match new patterns of work and commerce. The transition is messy and uneven, but it eventually produces a closer alignment between the built environment and actual economic needs. The broader context for understanding this moment is the ongoing transformation of the global economy driven by technology, demographics, and changing social patterns. The shift away from traditional office work is part of a larger story about how digital connectivity has reshaped nearly every aspect of life. Just as the rise of e-commerce has fundamentally altered retail real estate, rendering many shopping malls obsolete, so too is the rise of remote work altering the calculus around office space. These are not temporary disruptions, but structural changes that will define the economic landscape for decades to come. The financial system, with all its sophisticated models and risk management tools, ultimately must grapple with these deeper shifts. When the assumptions built into trillions of dollars in loans no longer hold, the process of adjustment is unavoidable. The only questions are how quickly it happens, who bears the losses, and what lessons are learned for the future. In the end, the story of the commercial real estate maturity wall is not about a single dramatic event, but about an accumulation of stresses that test the foundations of the financial system. It is a reminder that value is not fixed, but contingent, dependent on the uses to which assets can be put and the income they can generate. When those underlying conditions change, The consequences ripple through layers of debt and equity, affecting everyone from individual depositors to global investors. The challenge for regulators, policymakers, and market participants is to manage this adjustment in a way that minimizes unnecessary damage while allowing necessary adaptation to occur. There is no painless path forward, but there are choices that can make the journey less destructive. As the next 18 months unfold and nearly $1 trillion in loans come due, those choices will shape not just the fate of commercial real estate, but the broader contours of economic stability and growth.